Are we going to new highs, or is this current market a setup for a correction? The price of the market or the price of a stock is set by future expectations. It is the aggregate of everything, including the fundamentals, interest rates, politics, time, etc. All play a role, but it is ultimately the aggregate expectations of the market participants who set the price. Currently, valuations are near record highs, but expectations are that continued low interest rates will support the economic growth and allow stocks to grow into their lofty valuations. The problem is when those expectations are disappointed. So let's take a look. The charts in this video come from Lance Roberts of realinvestmentadvice.com. In analyzing this first chart here, the important thing to see is that in the middle portion of the chart, you can observe that the long-term trend lines, which are shown here in red, were broken in the year 2000, in the year 2008, and the current time frame, but not in 2016. So again, here's up leading up to the year 2000. Here is the market leading up the year 2008, and here is a current time frame. Right here is 2016, and then here we are today in 2019. And of course, this portion here in the right margin is a zoom in of the current market. So let's review the lead up in the stock market just prior to the onset of the last two bear markets in 2000 and 2008 and see if there's any similarities to today. Because as you can see by this chart, in 2000 and in 2008, the market didn't do well. Leading up to the year 2000, all we heard was that the internet was changing the world. We had survived the Asian currency crisis, and anything that ended with .com was burning up the stock charts. But at the time, the economy was strong, employment was good, and corporate earnings were continuing to impress. Certainly, this time was different, since the internet had changed the world and the stock market. However, that change did come in late July of 2000 as stocks recovered from previous dips but failed to reach new highs. The deterioration in price momentum was signaling that something was changing as the Fed had been aggressively tightening monetary policy. By December of 2000, the buy the dip mantra and buy and hold investing were no more. The all-time high printed in 2000 would not be seen again for 7 years. So fast forward to here in 2006. After the dot-com crash from 2000 to 2002, the market had recovered. Do you remember those who said, if you had just bought and held, you would be fine? Well, thanks for nothing. Those buy and hold investment strategies had once again returned to the media headlines. But now, mortgage rates were low, and there was a smorgasbord of no-cost, low-cost mortgage loans for attaining the American dream of owning a home. Wall Street had found a new trick to cheat the devil. At the time, nothing could go wrong as the flood of liquidity lifted all asset prices. Once again, we heard pundits say, this time was different, and we're in a Goldilocks economy. But after a stumble in July of 2007, the market came roaring back, ignoring the growing mortgage and real estate issues, and surged back to hit all-time highs. However, that all-time high would not be seen for another 6 years. And so here we are today. There are scores of investors and, more importantly, most financial advisors who were not in the markets during those previous periods. Many individuals simply sold out of the markets, or in some sad cases, lost most everything and never returned. Lots of financial advisors had to quit the business and begin a different profession altogether. But again, today we hear, buy the dip and buy the hold. It's again the mantra. More importantly, this time is different because the central banks have the markets back. But here we are at this point. Now, we've reached above the previous interim highs at this level here, but we need to reach to this trend line or perhaps to the new previous high at that level. This is what I'm watching very, very closely because just remember that tops are a process. Bottoms are an event. And right now, the downside risk dwarfs the upside reward, at least in my humble opinion. So be safe and continue to stack that cash for the opportunities that will come. And for today, that's ChewDog Charts. Thank you.